I want to continue with the M&A model and just kind of finish this up. We already, as you remember, laid out the initial assumptions. And, the idea is to keep this in mind if you're asked to do a model case, right? So the exam, the M&A exam that's coming up won't be a model case, it'll be a paper case, but we've done the paper, we'll do more paper. But if there's a model case, just kind of keep this in mind. We'll do model cases later, but LBO model cases. And so what we had done was we had thought about step one, which was the core considerations. We had went through the uses and the sources, which is step two, uses being where we're coming up with the money, and I had given you the transaction fees and the retirement target net debt, and the sources, how it's being funded, and that was given. So a lot of questions might come about when you're doing this in a real scenario. How do you find this stuff? That will hone in part two, right, with the Office Depot, Office Max. So really, hopefully you should be understanding what do you need specifically just to get this analysis done. And so you need core target statistics, core acquired statistics. When I say core, just enough to get to EPS. So we saw that yesterday on the board. Even with just EBIT, you can kind of get to an EPS. But if this is a real company, you want to get as much data as you can to get to EPS. And then you do need some balance sheet information, right? You need balance sheet, retirement target net debt. You need balance sheet book value to get goodwill. We didn't do that yet, but we'll do that soon. We need balance sheet book value. And that's pretty much it, right? With that, you can do the analysis. So I want to talk about doing the analysis and performing the analysis. So a couple things about the mini-merger model. A couple flaws with the mini-merger model versus the full scale. And this is illustrated in the book, and we'll talk about this when we start doing the full scale, is one, it's just a brief, right? It doesn't give you the full core financials. So it gives you EPS impact, doesn't give you cash flow impact, doesn't give you balance sheet impact. Right? That's the full scale. Two, it's tough to be very accurate with timing, right? You're basically just doing like the comps, right? You're doing like a quick LTM, maybe a quick one-year projection without full financial detail getting to evaluation. You can't be so accurate with timing. And then three, you'll see this in the transaction adjustments. The nature of the way we're doing the transaction adjustments are quite broad. So for example, if you recall on the board, it's easier to see once we do this, and I'll reiterate this. When we're doing interest expense, for example, we're taking the debt raised, or new interest expense, we're taking the debt raised times the interest rate, right? And then we're just keeping that flat, assuming that whatever debt raised, if it incurs 10% interest, then that 10% interest, whatever record, will be held in 2014, 15, 16. Where in reality, with a full-scale model, with a working debt schedule, that might, if you have a cash surplus, might be paid down over time. Your interest expense might change, might increase or decrease, depending on how debt is adjusting year after year. So we don't have that complexity in this simple model. But it's considered conservative to assume that the interest expense will stay flat. In reality, maybe if you have a lot of cash, you'll slowly pay down that debt and reduce the interest. So let's see how it works. So remember, the procedure for when you have acquire and target statistics is first you're adding together everything line by line, revenue down to net income, except for items dealing with target debt and target equity. Why? Because target debt has been paid down. So that means what? No target interest. Acquire interest only. No target equity. Target equity, why? Equity's been bought out. So no target shares. So we're just being left with the acquire equity. So we're going to add revenue, acquire plus target, cost, acquire plus target, all the way down to net income. But when we see items related to debt and equity, so specifically interest expense, it's acquire only. Shares, acquire only shares, right? And then we're making four significant transaction adjustments. One, an estimation for synergies, post-merger cost savings. Two, we're going to figure out how to calculate amortization on any identifiable intangible assets post-acquisition. That new amortization is new expense. Three, we're raising debt to fund the acquisition, so we're going to have new interest. And we're raising equity to fund the acquisition, so we're going to have new shares. We're going to make those 4 transaction adjustments. So this should illustrate everything nicely. So revenue, first, acquire plus target revenue. So we're going to have 2014 equals acquire revenue plus target revenue. Very simple. Copy this to the right. Again, this is meant to be overly simplistic just to show you and illustrate and highlight the major movements. And we do the same with the expenses. So the expenses is 2014 acquire expenses plus target expenses. Copy that to the right. You guys got that? And then synergies, if you notice, there's an assumption up in the considerations box, cost savings 3%. Let's assume 3% of the expenses are cost reductions. So we're going to take 3% times the expenses. And I'm going to make it negative because it's going to negate against an expense. So I'm going to do minus the expense times the 3%. I'm going to anchor the reference to the 3%, so when I copy this to the right, the references to the expenses will shift, but not to the actual percentage. So it's 3% of expenses we're assuming are being reduced. Say it again? 3% times the expenses. And so the total expenses is the sum of the expenses after the synergies. Right? And then your EBITDA is simply revenue less expenses now. Right? Revenue after expenses. So you notice in this model we didn't separate COGS from other OPEX and SG&A. In other words, we just didn't get into very much detail with the types of expenses. But you could have. You could have broken it out. But in this case, the only thing that's going to impact our expenses are synergies, so we made an assumption already. The breakout in detail here wouldn't make too much of a difference. Okay, now we have D&A. And so D&A is going to be, again, a sum of the acquire and target D&A. You're consolidating PP&E, you're consolidating the assets, you're consolidating the depreciation and amortization. Again, I mentioned the difference between this accretion dilution analysis or a mini merger model and a full scale is the lack of detail in some areas. In the full scale model, we can get more detailed with the PP&E. What if the target company's PP&E will be written up or written down, or if there's some adjustments to that PP&E? That might impact your depreciation. We're going to build a fresh depreciation schedule in the full scale model. Here, just real simple. Acquire plus target. All right, acquire plus target D&A. And then we have our second adjustment, which is the amortization of newly identified intangible assets. We spoke about this yesterday. There's this goodwill box that's going to help us determine what those assets are. Right? So first of all, we take the purchase price and we compare that with the target company's book value. So what kind of premium are we paying above the target company's book value? Because that gap, that premium, that difference needs to be accounted for in some ways. And there's several buckets that goes into, mainly goodwill, but there's several buckets that goes into. And we'll talk about the further detail in the full-scale analysis, but for now it's mainly goodwill, and we want to talk about the allocation of that could be attributable to intangible assets. Right? So first we take the price over book value, so we subtract purchase price minus book value. And based on our assumptions, we're assuming for now that 25% of that difference is going to newly identified intangible assets. The rest is goodwill. Right? Goodwill doesn't affect our income statement, though, right? It's not it's not amortized. It's the rest that is amortized. So 25% of that will be spread out over 15 years. Yeah. So we're going to take the price of a book times 25% divided by 15. $854.2. So that's 854.2. That's going to be an additional expense, right? We've allocated and identified these new intangible assets based on the fact that we've paid more than what the company was stated as being worth on its books, and we're questioned why. So a lot of it is just goodwill. This just sits, but some of it can be allocated to intellectual property, branding, and that gets amortized. So we've identified, based on our assumptions, what that would be, and then now we add that to our expenses. That's 854.2. We're going to anchor the reference to that so that it stays flat. And so the new total depreciation is the old depreciation, which is the sum of the acquire and target, plus this new adjusted. Got it? And you can calculate EBIT, right? EBITDA minus D&A. Questions so far? Everybody have 15474.8 for EBIT. I want to make sure we're all following. Everyone okay up to this point? Anyone need a second? Okay. So interest now, we mentioned before, the target debt has been paid, so target interest is gone. So we're just keeping the acquirer's interest as stated in their acquire statistics. Acquire interest only. Target debt has been paid, target interest is gone. Remember, we're adding together line by line everything except for items related to target debt and target interest. Target debt's gone. Yeah? Questions on that? We do, however, have new interest, assuming that we're raising debt to fund the acquisition, and we are. How much debt are we raising? It's up in the sources. 65825.0 times the projected interest rate, which we have listed as 5%. So that's 6825.0 times 5%. That's the new interest based on the funds raised. So E7 times C12, we can anchor that so that we can copy this to the right. So for interest expense, for total interest, it's the acquirer-only interest, target's gone, and then the new interest based on the new debt raised. And we'll add that together, and we can calculate EBT, earnings before tax, by taking EBIT and minusing the I, minusing the interest. So we can now calculate taxes, of course, which is EBIT times the proposed tax rate from the considerations box that you can anchor so that we can copy this to the right. and net income is EBT minus tax. And we'll divide that net income by the shares outstanding to get the earnings per share. Everyone have that? Shares outstanding, again, we're adding together acquire plus target line by line, except items dealing with target debt and target equity. Shares is target equity. So we're taking only the acquirer equity. So shares outstanding is going to be equal to the acquirer shares outstanding only. And we have our final adjustment, which is new shares, right, based on equity raised. If we're raising equity to fund the transaction too, the acquirer is raising that equity at its stock level, we're going to assume. In other words, the acquirer is raising 65825 of equity. So it's raising 50% equity, 50% debt. So the amount of stock being raised is the 65825 divided by what? Say again? Yeah, 100. Right? It's going to raise funds at its stock price, which is 658.3. So we can anchor that and copy to the right. So the total adjusted shares is the acquirer shares outstanding plus the new shares. And then we divide to get the earnings per share. So net income divided by acquirer shares is 176 all the way to 213. And I'll give you guys a second to kind of catch up if you're not caught up. Good. All right, so the accretion on that is the difference between the new EPS and the old acquirer's EPS. So first, there's two different ways of looking at it. There's the cents increase or decrease, and then there's the percentage. So $2.13 minus the original acquirer of $2.12 gives us an accretion of 1 penny. I just subtracted. Right, so here in this case, it's dilutive in the beginning, and then it slowly becomes accretive. Oops.
So it's always after today's earnings per share?
No, you should do it in the same year. Is that what you asked? I'm sorry. So I did like 2014 versus 2014. Then 2015 versus 2015. But it's new versus old.
So how did you get 1 penny in the last year?
It was the new 213. Did I do something wrong here? New 213 minus the old 212. Okay. Yep. And then we calculate the percentage, which is the difference divided by the original. Or you can do this EPS minus divided by last EPS minus 1, just any type of growth formula. And that gives you, it's dilutive in the beginning, slowly getting to break even. Right? We will talk about what that means in a second. But first, we'll get into the statistics. And I want to make sure you guys have this. Any questions on this? Any matching you need to do? Taxes is the EBT times the tax rate, which we listed up above, 35% up of the considerations. And the adjusted newly issued shares is the equity raised divided by the acquirer stock price. You guys okay with this? Okay. Now I just want to, on the side, look at the acquirer pro forma multiples. This is what's the company consolidated going to look like when it's trading out in the market. So a couple questions about the numerator. When I say the numerator, the market cap and the enterprise value, the numerator of these multiples. And then the denominator is clearly going to change because it's based on consolidated financials. So first of all, the market value, let's just conservatively assume that the acquirer stock price will not change. That's a pretty crude assumption, though, because usually in an acquisition, the acquirer stock price drops by 5, 10, maybe even 15%, right? So let's just, for now, take what's clearly changing here, and what I want to capture is the number of shares is going to increase. So whether the stock price goes down by 5% or 10%, really the heart of what we're going to see as a difference is the fact that our shares have increased from 3 million to 3.6 million. So that's what I want to capture. So the market value is going to be based on the acquirer stock price, and I'm going to anchor the reference to that because that doesn't shift to the right, times the total adjusted shares, the 3658. That's the market cap of the combined entity. This is in contrast to our purchase multiples above, our acquisition multiples, where we're looking at the price paid for the target company, just the target company, and the target company's statistics, right? How much are we paying for just the target company? It's not the trading value of the target company. It's not the trading value of the consolidated entity. So for the acquisition multiples, the numerator was based on price paid, and the denominator was based on just target statistics. The pro forma multiples is more like the comps. It's more like how the company's going to trade out in the market. So we're going to base this out of the consolidated statistics based on the consolidated stock price, share count, and the consolidated underlying financials. So what we did need was the existing debt on the acquirer. Notice that we haven't even considered the acquirer's existing debt. It didn't matter. It didn't go anywhere into the income statement. I mean, okay, so the existing debt did calculate existing interest expense, but we've already reported the existing interest of the acquirer right here. So we didn't actually need the value of debt. We just needed the interest on the debt, which is already in our model, right? But we do need the acquirer debt to calculate pro forma enterprise value, because enterprise value is market cap plus net debt. So we need the acquirer's debt plus the new debt that the acquirer raised to fund the transaction, which is equal to the 65825. And I will anchor that and copy that to the right. So you guys kind of understand what I'm doing here? Right, we need market cap plus net debt. And the net debt, remember, after the acquirer absorbs the target, we need to understand the consolidated entity. Well, what debt is on the consolidated entity right now? It's the acquirer's debt plus any new debt raised. The target debt's been wiped out. So that's what we're doing. So the total debt is the sum of the two. And the enterprise value is the market value plus total debt. Okay, so now we divide by the company's underlying statistics to get to the appropriate multiple. So enterprise value per sales is the enterprise value divided by the target company's revenue, or sorry, the pro forma company's revenue, 17.4. The enterprise value to EBITDA is the enterprise value divided by the EBITDA. This should be pretty straightforward. Enterprise value to EBIT, enterprise value divided by EBIT. Market value to net income is the market value from above divided by net income. And price per EPS is the price per share. So we're assuming that the price per share is 100. So we're going to go up to 100 and anchor that divided by the earnings per share. And that should be equal to the market value to net income. It's basically the same metric, right? The market value divided by the number of shares outstanding is the price, and the net income divided by the number of shares outstanding is the EPS. It's almost the same metric. It is the same metric. So let me save this and just make sure you can match these numbers. All right, let's interpret the results here. So first, we've done sensitivity tables on the DCF, right? The point of the sensitivity table is to be able to look at a glance and to have it automated so you don't have to redo it each time, what sort of, how the output would change based on varying variables, right? So, for example, there are a lot of variables here. We'll hone in on what the variables are when we're done with this. But the two major variables is the split between equity and debt and the premium, right? So what happens if the split between equity and debt will change? What happens if the premium will change? How will that impact the EPS? So let's focus on, for example, 2016 EPS, right? Well, 2016 EPS is zero. It's zero, it's break even when you're buying the business at a 25% premium, splitting 50-50, 50% equity, 50% debt, right? What happens if the equity shifts from 0 to 100%? So in a 0% equity case, if we're raising all debt, how will that change the accretion dilution? In a 100% equity case, all equity, no debt, how will that impact accretion dilution? If our premium goes up or down, how will that impact our accretion dilution? So one way we can do this is to go up to the top and change our assumptions one by one and look at what the answer is and cut and paste the answer into the appropriate quadrant in the Excel, in the table here. All right, so for example, right now we're running the 25% premium, 50% equity, 50% debt case, so 0% would be in here, right? And then we can run the 0% equity, 5% case, find out what the answer is, and plug it in here. Or we can run the 100% equity, 15% premium case, and plug it in here, etc. And then we have to change this all the time. Or there's a way to automate this, and that's by using a two-variable data table. So let's show you how to do that. The first requirement is in the upper left portion of the table. We need a link in from the model from a cell that we want the table to be populated with. So we want the table to be populated with, let's say, 2016 accretion dilution percent. So let's have G44 be equal to E52 because we want the table to be populated with the 2016 EPS accretion dilution. That's requirement number one for a two-variable data table. Requirement number two is to the right of that data table, we need a series of variables, hard-coded, 0, 50, and 100%, that will impact that result if changed somewhere in the model. So this will be the percent equity. Underneath a second series of variables that will impact the result once changed in the model. Let's consider this 0, 5, 10, 15, 20, 25, 30% premium. Then we highlight the entire box. It'll overwrite what I put in the middle. We'll highlight the entire box, including that upper left corner, not the headings though, just from the upper left corner and the variables throughout the box. And then depending on what Excel you have, you can do Alt-DT, data table, Alt-DT, or you can go to data, what if analysis, data table, and everyone should have this box, right? Row input cell, column input cell. Anyone have difficulty finding the box? Okay. And the row input cell is asking, of the variables across the row, because it's hard-coded, it doesn't know where that comes from. Where do you go in the model to change those variables, to change the output? These variables across the row, 0, 50, 100, we want this to be reflective of the percent equity. Percent equity. And this is why I said in the beginning that this percent equity, oops, I need to make sure I'm clicking the box. Oh, did I lose it? I lost it. Let me do it again. I didn't click. I thought I clicked in the box. Oh well. This is why I mentioned in the beginning of the 50%, 50%, 100% assumption drivers, one should be hard-coded, and the other needs to be dependent on the hard-coded one. Because if we run the table, and they're both hard-coded, and the table is changing that top 50%, it'll change that top 50% to 100%. If the bottom one is not dependent on the first, you're going to have a scenario with 100% equity and then 50% debt, and that's not going to make any sense. So the second percentage needs to be 1 minus the 50%, so that when it changes one percentage, the other one changes reflected on whatever's left over. Otherwise, it's not going to work. The column input cell is saying, all right, of the percentages up and down the column, where does it go in the model to change that variable that would affect the output? That's the premium. We want this to indicate an adjustment in the premium. So column input cell, we're going to allocate to premium, and we're going to hit OK. And this is what everyone should have. I'll take a second, make sure you guys get the same numbers. Some of you might not. All right, what does this mean? What does it mean, and does it make sense? That's the most important thing. Well, not the most important, but part of it is how to put it together. The things that kind of throw you guys off a lot, that are very technical oriented, is how to interpret it. Let's interpret it. What's going on? Does this sensitivity table make sense? As we are increasing the premium, what's happening? Yes?
I want to say where I'm getting a discrepancy is because I'm adding an adjusted, a new adjusted issue shares. I don't see that on the consolidated system. I think that's where my discrepancy is. Please now he's running on the scenario.
Yeah, I'm running a different scenario. Yeah. Okay, so as we increase in premium, what happens? EPS more diluted. Does that make sense?
So it means if you increase 10%,
Mm-hmm.
then 50%.
If you increase from 5 to 10, 15, 20, 25, 30, it becomes more dilutive. Does that make sense?
Yes.
Yes? Why? And then how does that impact the dilution? Paying more, which is affecting the dilution how? Issue more shares, and what else? More interest expense. Right? That's really what's impacting the dilution. Yeah. What about left to right? So as we're increasing the equity, right? We're going from 0% debt to 100% equity. What's happening? 50% is half.
Yeah. So 0 is all debt.
0 is all debt. So as you go from 0% debt to 100% equity, what's happening? Well, what's happening?
EPS goes up.
EPS goes up, or it's more accretive. Does that make sense? What do you think? What happens as we add equity?
You have less interest. Right.
You have less interest. But you replace that with equity, which is issuing more shares. What has more of an impact to dilution? Issuing shares. So why here, when we're issuing shares, it's not impacting dilution? Does this make sense? So does this make sense? Is this normal? It's not normal.
Is that normal?
It's not normal. You just asked the same question I asked you. And it's not. And you're right. No.
But the target statistics, so when you look at them, I mean, their earnings per share is higher, of course, everybody.
Exactly.
But they have it's not like you're acquiring much smaller companies, so it's not a small effect. So it's close to equal size as far as revenue.
Yeah, right. But that makes it even more of an interesting case. So why in this case, and you kind of hit the nail on the head, but why in this case, when we're raising equity, it's not only less dilutive, it's actually accretive. When raising equity should be more dilutive based on, we talked about CAPM and the whole idea that an investor should expect greater return for equity as opposed to debt. And that greater return should be translated as dilution. Right? Dilution in the standalone entity. This is not a standalone entity, so there's other things at play here. But the idea is we're looking at the same acquisition throughout this box, but just replacing debt with equity. So the shift from debt to equity should be impacted by only the way the acquirer is raising its funds, right? And the impact of raising debt is what? What's the driver? Interest. And the impact of raising equity is shares. We're driven by what? The share price. So in reality, and we've proven this with the standalone model, right? We've tried raising debt, and it was dilutive by like a penny. Remember that? It was like, whatever, $6.24, $6.23, I forgot what it was. And then we raised equity, and it dropped like 60 cents, right? But something must be happening to flip around the situation. Yes, Nick?
Because you're paying a premium, the share price goes up. So it would.
That's, yeah.
So I'm looking at it as like offsetting the amount of shares because the share price is going up.
Right.
What you're paying for the company.
Right.
And that's why it gets closer to like an equilibrium as you increase the premium.
It will, and yes, and I'll show you a way to look at that. So you're absolutely right. So it definitely has to deal with the share price, but you're doing that with the share price of the target or the acquirer. It would be the acquirer.
Right.
Yeah.
But we assume $100.
Mm-hmm.
Well, we said that in reality, that comes down.
Well, this is where the share price is kind of arbitrary, right? Unless you compare it with the earnings, because that's what's being merged. So the idea is something must have flipped the standard logic that raising equity is more dilutive than raising debt. So usually when that happens, it's either the interest rate is so high that all of a sudden the cost of interest is a lot more than the cost of equity, but then the interest has to be like 25%, right, after tax. Or maybe like 20, or maybe like even 17. But or there's something different about the equity, and the equity is being driven by the share price. So there must be something different about the share price. Well, what is that? Well, when we look at the $100, and you guys were mentioning the $100, is that high? Is that low? It's irrelevant unless you compare it with what the company is producing. So if you look at the $100 in relation to the acquired company's earnings, what's its earnings? So it's about $2. So $100 divided by 2, PE is 50. Right? So how does that fall into place? Is that high? Is that low? Say it again?
So if you take the inverse of that, so 30 times the PE, given is 2%, that's essentially what we're going to be yielding and all this kind of stuff, right? So if you look at it that way, then you look at your interest rate, which is 5%, then it makes sense that the equity is going to be less diluted through that.
So you take the reciprocal.
Yeah, the reciprocal.
Share, or the PE or that.
And why is that?
That's the expected return.
Combination of what you're going to do.
Yeah, but why? So what does that mean for the PE?
It's high.
It's high. What's the average PE? It's about 15 times, right? What's the reciprocal of 15? 8%? Yeah. Higher than what you estimated at 3. But so on the PE terms, so you're absolutely right. So on PE terms, right, a 50 times PE is quite high when you compare it to the standard of the market of 15 or 16 times PE. So what does that mean? What does that mean for the company when it's raising equity? It's overvalued, which means it's cheaper. It can go out and meet its funding needs, right, for a lot less shares, right, for raising a lot less shares than it would need to. So in a standard environment, if the company's trading at like 15 times earnings, maybe it would have to raise, 2,000 shares, not 600. I didn't do the math appropriately, but you know what I'm saying. A lot more shares to meet its funding needs. It only has to raise a very little amount. Why? Because the share price is high. And who's setting the share price? The market. The investors are setting the share price. Why are they setting the share price such that it's so much higher than the returns for raising debt? Why wouldn't the investor see this and start lending debt or start investing in debt instead of the equity? Speculation, who knows, right? So, this is where a lot of companies, when the companies are overvalued, can go out and raise money and meet its funding needs with raising a lot less shares and being a lot less dilutive. And so back in 2000, 2001, companies were doing this. Companies were way overvalued, 100, 200, 300 times, even companies not like that. And what do? They went out to raise money and to acquire a lot of businesses. And they were accretive. Now, is that accurate? And you look at a great example is America Online buying Time Warner, right? Time Warner is a company with big, hard, storied assets, and they were acquired by a tech company. And America Online raised, I forgot how much it was, but it was a stock swap. They raised all equity to do this. Why do they do that? And it was accretive. Why do they do that? Because investors were willing to pay the money. And so back then, there was a lot of these articles in the Wall Street Journal about how they raised equity to do this, and it was accretive, and CAPM is wrong, and it doesn't work anymore. And I disagreed with that. I thought that CAPM is right, but CAPM is in an environment where you assume that investors are rational, right? And so I think the idea is, back then E-Trade was just coming out, and Ameritrade, and there's all this hype on tech companies, and you're able to easily trade stocks by putting your credit card online without the advice of a broker. That was like a first, right? I think a lot of people were just irrationally investing in the stock. I mean, that's my opinion, but there's two sides to that, right? So CAPM works, assuming that it's priced as such that if you were to see this and say, wow, I'm paying a lot of money for this stock, I would much rather invest in debt and get a better return. How do I prove that? Well, if the company was trading at a normal 15 to 16 times range, you should see a standard CAPM-driven trend where debt would be dilutive, but equity would be more dilutive. If I'm going to put risk on the table by investing in equity, I would expect more dilution. I'd expect a bigger piece of the pie. I'd expect this to be more dilutive. Right? So we can prove that. We can prove that by forcing the acquirer stock price to be small enough such that the PE is around 15 times earnings. Right? So if the stock price at 2 times earnings, at 2 EPS, if the stock price was 30, right? If we change the acquired stock price to be 30, then the PE would be 15, more normal. If the acquired stock price is 30, then here we see a normal trend. Right? Here we see. Notice that this column doesn't change at all because there's no equity in here. But the 100% equity case now is more dilutive. This is a standard trend because the investor is now pricing the stock commensurate with the appropriate risk. Right? So what happened? We all know what happened with America Online, Time Warner. Right? Stock price dropped, market corrected, and then they had to write down a lot of assets, kind of destroyed the company in a lot of ways, right? And then they had to, what do? They divested some of the assets. It's now Time Warner again, right? They did some sort of management reverse overhaul. And that was a problem. But everyone was in this bubble, right, where they said, oh, CAPM doesn't make sense anymore because the collective investor is pricing. The idea was that PEs are high because they're pricing future growth in the stock, but the growth wasn't there. good lesson on technicals aren't everything, but they could give you a good picture as to, where things can fall into place in terms of rational investments and the value of investments. So we'll see more of that in the LBO. Any questions on that?